March 28, 2022. 4:01 p.m. Eastern Time. The U.S. Treasury Department freezes $330 billion in Russian central bank assets. The largest sovereign wealth seizure in modern history. Not in gold, not in commodities, in digital entries. With a keystroke, the world's premier reserve currency was transformed from a neutral medium of exchange into a geopolitical weapon. Global finance held its breath. And a 600-year-old trap, one that has destroyed every dominant economic power before it, slammed shut once more. This is not a story of wars or revolutions. This is the story of the reserve currency trap. This is the fatal, predictable pattern that has ended every single era of global monetary dominance. From the silver of Spain, to the guilder of the Netherlands, to the pound sterling of Britain. When a reigning financial superpower chooses to weaponize its currency, to turn its ledger into a battlefield, it initiates a terminal, five-stage collapse sequence. It trades long-term trust for short-term power. And it always loses. The pattern is clear, it is data-driven, and it is brutal. It unfolds in 5 irreversible stages: the Weaponization Decision, the Silent Flight, the Challenger's Gambit, the Liquidity Crunch, and Terminal Abandonment. History proves this cycle is not theoretical. It is a historical law. Spain weaponized the silver real in the 1600s and was bankrupt by 1647. Britain weaponized the pound sterling in 1956 during the Suez Crisis and triggered its own sterling crisis by 1967. And today, the United States dollar, the backbone of global trade for 80 years, has entered stage 1. The decision has been made. The clock is ticking. This is the story of why empires that play this game lose it, and why we are playing it again right now. To understand the trap, you must first understand the pinnacle. The absolute power of being the world's reserve currency. It is not just about having the strongest economy or the largest army. It is about becoming the operating system of global commerce. It means your currency is the default for international trade, for central bank reserves, for sovereign debt issuance. It grants the issuing nation an exorbitant privilege, the ability to print the very money the world needs to function, to run near limitless deficits, and to sanction any actor on the global stage with devastating effect. By 1950, the U.S. dollar controlled over 70% of all identified central bank foreign exchange reserves. The Bretton Woods Agreement of 1944 didn't just tie the world to gold, it tied it to the dollar. The dollar was gold. This dominance was cemented by the petrodollar system of the 1970s, binding the global trade of oil, the lifeblood of industrial civilization, to the greenback. For decades, the system seemed invincible, a perpetual motion machine of demand. The U.S. could borrow cheaply, spend lavishly on global military projection, and export its inflation abroad. The world needed dollars more than the U.S. needed the world's approval. But this dominance creates an illusion of infinite leverage. An illusion that the rules of economic gravity no longer apply. The currency becomes more than money. It becomes an instrument of statecraft, a tool too tempting not to use. The turning point is never an accident. It is a deliberate, calculated choice made in a moment of perceived threat or opportunity. The reigning financial superpower, facing a geopolitical rival or a recalcitrant state, looks at its ultimate weapon and decides to pull the trigger. It decides that short-term coercive power is worth more than long-term financial credibility. The modern blueprint was drawn not in 2022, but in 2012. The Obama administration, targeting Iran's nuclear program, weaponized the dollar's central nervous system, the SWIFT financial messaging network. Iranian banks were cut off from the global dollar system. The move was devastatingly effective. Iran's oil exports plummeted by over 60%. Its currency lost half its value. The world took note. The weapon worked. But a precedent was set. A line was crossed. The dollar system was no longer a neutral utility. It was a tool of foreign policy. For a decade, the use escalated. Sanctions lists expanded from hundreds to thousands of entities. Secondary sanctions threatened any foreign bank doing business with targeted states. The weaponization became routine, bureaucratic. And then came February 2022. Russia's invasion of Ukraine presented what seemed like the ultimate test. The response was the ultimate escalation. In a coordinated move by the US, EU, UK, and Canada, selected Russian banks were removed from SWIFT. But the true earthquake was the freezing of the central bank of the Russian Federation's assets, over $300 billion held in Western institutions. This wasn't just cutting off a country from the future flow of dollars. It was the confiscation of its past savings. Its national piggy bank, held in what were considered the safest custodians in the world, was suddenly gone. Treasury Secretary Janet Yellen called it an unprecedented action. She was wrong. It was precedent in the playbooks of dying empires. The decision was made. The Weaponization Decision, stage 1 of the collapse sequence, was now active. The silent signal was sent to every finance minister, every central banker, every commodity trader on Earth. No asset in this system is safe. The hunt for an exit began. History does not repeat, but it rhymes with terrifying precision. The collapse of a reserve currency is not a single event. It is a process, a 5-stage autopsy of imperial overreach. We have identified this pattern across 3 definitive superpower transitions. Study them. The dates, the numbers, the identical decisions. The Spanish Empire, the silver real, 16th to 17th centuries. The British Empire, the pound sterling, 19th to 20th centuries. The Soviet economic sphere, the transferable ruble, 1945 to 1991. These are not obscure footnotes. They are the 3 most recent, complete cycles of reserve currency collapse before our own. Their timelines compress as financial technology advances. Spain's cycle played out over 80 years. Britain's over 40. The Soviet ruble's over 25. The pattern accelerates. And now, we trace its steps. Stage 1, the Weaponization Decision. The superpower, confident in its unshakable position, uses its currency system as a coercive tool against a geopolitical adversary. It mistakes ubiquity for invincibility. Historical example 1. Spain, 1590s to 1620s. King Philip II and his successors repeatedly defaulted on sovereign debt, 1557, 1560, 1575, 1596, owed to Genoese and German bankers. This was a direct weaponization of the silver real's dominance. Lenders had no alternative but to accept restructuring. Their wealth was stored in the king's currency. Each default was a short-term victory, raising immediate cash for the Spanish Armada and Continental Wars. The consequence, the Genoese banking families, the central financiers of Europe, began a century-long shift north to Amsterdam, taking their networks and trust with them. Historical example 2, Britain, 1956. The Suez Crisis. Britain, France, and Israel invaded Egypt after its nationalization of the canal. U.S. President Eisenhower, opposed to the action, threatened to sell British gilt holdings and crash the pound sterling unless Britain withdrew. The UK, despite being a victor of World War II, was forced into a humiliating retreat. This special relationship had a financial gun to its head. Chancellor of the Exchequer Harold Macmillan wrote, "It was the end of the British Empire." The pound's credibility as a neutral global asset was shattered. Historical example 3, the Soviet Union, 1979 to 1985. Following the invasion of Afghanistan, the USSR demanded all Council for Mutual Economic Assistance, Comecon, satellite states use the transferable ruble exclusively, cutting them off from dollar trade. This was a forced weaponization of its captive monetary zone to isolate the bloc and punish dissent. The immediate result was a surge in black market dollar trading across Eastern Europe, as satellites sought any escape from the ruble trap. The system's internal trust evaporated overnight. The lesson is universal. The moment you force your currency to be a weapon, you announce it is no longer a safe haven. Stage 2, the silent flight. Capital is cowardly. It leaves in whispers, not screams. Global players, having seen the weapon deployed, begin a multi-year, quiet, strategic diversification away from the dominant currency. Official narratives dismiss this as noise. The data shows a hemorrhage. Historical example 1. Spain, 1620s to 1640s. As Spanish Habsburg power waned, Amsterdam's Wisselbank, Bank of Amsterdam, was founded in 1609, offering a stable, reliable depository. It attracted not just Dutch trade, but the flight capital of Spanish nobles and merchants seeking to protect wealth from a bankrupt crown. Spanish silver continued to flow into Europe, but it was increasingly reminted into Dutch guilders and bank deposits. The source of money remained Spanish America. The store of value became Dutch. Historical example 2. Britain, 1956 to 1967. In the decade after Suez, the sterling area, countries holding reserves in pounds, began an irreversible erosion. Official sterling reserves held by foreign countries fell from 55% of global reserves in 1955 to 27% by 1967. The key move, France, under Charles de Gaulle, began aggressively converting its dollar and sterling holdings into physical gold, publicly challenging Anglo-Saxon financial dominance. This was not a market panic. It was a calculated, political flight by a major power. Historical example 3. The Soviet Union, 1985 to 1989. Soviet satellites like Hungary and Poland began secretly negotiating trade deals in Deutsche Marks and US dollars. The dollarization of Eastern European black markets became overt, with hard currency shops appearing stateside. By 1989, an estimated 30 to 40% of internal Comecon trade was being unofficially priced in dollars, a silent vote of no confidence in the ruble. The silent flight is measured in balance sheet percentages and bilateral trade agreements, not headlines. It is the smart money exiting first. Stage 3. The Challenger's Gambit. A rival economic power, observing the weaponization and the silent flight, sees a historic opportunity. It proactively builds the institutional and market architecture to present its own currency as a viable, neutral alternative. It does not need to be stronger. It needs to be safer. Historical example 1. The Dutch Republic, 1640s to 1670s. Amsterdam established the world's first modern central bank, Wisselbank, a fully functioning stock exchange, Euronext Amsterdam, and a deep market for sovereign debt. It created financial stability so powerful that the Dutch guilder became a hard currency, even during wars with England. The system was designed for impartiality and reliability, directly contrasting with Spanish capriciousness. By 1670, the guilder was the undisputed trade and reserve currency of Northern Europe. Historical example 2. The United States, 1960 to 1971. Seeing sterling's weakness, the U.S. and financial elites actively built the eurodollar market, a pool of dollars held outside the U.S., free from direct Federal Reserve control. This created a parallel dollar system that was, ironically, more neutral and flexible than the domestic one. Simultaneously, the U.S. pushed the IMF's special drawing right, SDR, in 1969, a nascent attempt at a super-sovereign reserve asset, further undermining sterling's unique role. The Challenger system was built using the dollar, preparing for its own ascendancy. Historical example 3. The European Economic Community, 1970s to 1990s. Following the collapse of the Bretton Woods gold peg, European nations moved to create a zone of monetary stability independent of dollar volatility. The European Monetary System, 1979, and the path to the euro, launched 1999, were direct institutional responses to the weaponization of the dollar during the 1973 oil crisis and subsequent volatility. It was a decades-long, multi-trillion-dollar project to create a challenger of sufficient size and depth. The challenger does not win by force. It wins by offering a sanctuary. Stage 4. The Liquidity Crunch. The now weakened dominant power faces a crisis, often a war or domestic financial blow-up. It needs to borrow enormous sums, fast. But the silent flight has eroded its base of reliable lenders. It is forced to print its own currency on a massive scale to fund itself, triggering a vicious cycle of inflation and loss of confidence. The exorbitant privilege becomes an exorbitant burden. Historical example 1. Spain, 1640s to 1650s. Simultaneous revolts in Catalonia, 1640, and Portugal, 1640, plus the ongoing 30 Years' War, forced Spain into fiscal overdrive. With trustworthy international creditors gone, it relied on massive debasement of coinage and printing of vales, paper debt. This triggered hyperinflation in Spain, while the price level in stable Holland remained flat. The same silver real bought less in Madrid than in Amsterdam. The Spanish crown declared its ninth and final bankruptcy in 1647. Its financial system was hollowed out. Historical example 2. Britain, 1967 to 1976. The UK's persistent balance of payments deficits led to a run on the pound. In 1967, PM Harold Wilson was forced to devalue sterling by 14.3%, a public humiliation and admission of weakness. The 1973 oil crisis exploded the UK's import bill. By 1976, the UK required a $3.9 billion IMF bailout, the largest in history at the time. The lender of last resort to the empire had become a debtor. The IMF's conditions forced deep austerity, breaking the post-war social contract. Historical example 3. The Soviet Union, 1989 to 1991. The collapse of oil prices in the 1980s eviscerated the USSR's hard currency earnings. To maintain the system, the Gosbank printed rubles to cover massive subsidies to satellites and domestic industry. This led to the famous Soviet shortage economy, not a lack of goods, but a collapse of faith in the ruble. Savings were worthless. By 1991, the USSR was bartering oil for food. Its currency was dead for international purposes. The liquidity crunch is the point of no return. The financial facade cracks, and the structural rot is exposed to all. Stage 5. Terminal Abandonment. A final, defining event proves the old system is broken beyond repair. Key allies or critical markets publicly abandon the currency. A new system, often centered on the challenger, is formally or informally adopted. The transition is sealed. Historical example 1. Spain, 1650 to 1670. The Peace of Westphalia, 1648, ended the 30 Years' War and redrew Europe's map without Spanish hegemony. The Treaty of the Pyrenees, 1659, cemented French ascendancy. Crucially, international treaties, especially the 1667 Anglo-Dutch trade agreements, were increasingly denominated in guilders, not reals. The silver real became a commodity metal, not a governing currency. Historical example 2. Britain, 1979 to 1990. In 1979, the newly elected Thatcher government, despite nationalist sentiment, removed UK exchange controls, freeing capital to flee sterling entirely. The Big Bang of 1986 deregulated London's financial markets, not to save sterling, but to make London the global hub for trading dollars. The UK itself became the premier manager of the successor currency. By 1990, the pound sterling's role as a global reserve was a relic. Historical example 3. The Soviet Union, 1990 to 1991. In 1990, Comecon officially dissolved, ending the mandatory use of the transferable ruble. Former satellites like Poland and Czechoslovakia immediately pegged their new currencies to the Deutsche Mark and US dollar. On December 25, 1991, the Soviet Union dissolved. The ruble's zone ceased to exist. The abandonment was total, absolute, and irreversible. Terminal abandonment is not an economic statistic. It is a geopolitical fact. The world moves on, and the United States dollar is at stage 2. The silent flight. Right now, the weaponization decision of 2022 was the trigger. The world watched the $300 billion seizure. The signal was received. And immediately, in the fortified boardrooms of central banks and the treasury departments of rival nations, a single, silent order was given. Accelerate the exit plan. This is not speculation. It is visible in the cold, hard data they cannot hide. Current evidence. The flight is quantifiable. De-dollarization of reserves. The US dollar's share of global central bank reserves has plunged from 72% in 2001 to 58% in 2024, IMF data. This 14-point drop is not gradual decline. It is an accelerating collapse of market share. Gold buying frenzy. Central banks, led by China, India, Turkey, and Poland, have been net buyers of gold for 12 consecutive years. 2022 and 2023 saw the highest annual purchases on record, 1,136 and 1,037 tons respectively. This is not investment. This is strategic de-risking from financial assets to non-sanctionable physical sovereignty. Bilateral trade pacts. Since 2022, a wave of agreements bypassing the dollar has been signed. China-Brazil, 2023, India-UE, 2023, Russia-Iran, 2024, ASEAN discussions, 2024, all facilitating trade in local currencies. This is the institutional architecture of escape. Treasury exodus. Key friendly nations are reducing their U.S. Treasury holdings. China's holdings have dropped from a peak of $1.31 trillion, 2013, to $775 billion, 2024. Japan, the largest holder, is actively diversifying. They are not selling in panic. They are selling with purpose. The catalyst, a line crossed in bright red. The 2022 sanctions were not just another entry on a list. They represented a philosophical shift from freezing to confiscation. Discussions in the G7 now openly center on not just freezing, but seizing the $300 billion in Russian assets to fund Ukraine's reconstruction. Every finance minister on earth understood the new rule. In a geopolitical dispute, your reserves held in the dominant system are not assets. They are hostages. The revelation was stark. The foundational contract of the reserve currency, safety and neutrality, was null and void. The keeper of the ledger had become an active combatant. This single decision compressed a decade of silent flight into a 24-month sprint. The BRICS bloc expanded, adding major commodity producers. Saudi Arabia openly agreed to accept yuan for oil. The moves are tectonic, deliberate, and irreversible. Stage 2 indicators. The smoke before the fire. The silent flight leaves fingerprints. Here are 10 indicators proving we are deep within Stage 2. Indicator 1. Central bank gold holdings. 2010, 30,500 tons. 2024, 36,700 tons. World Gold Council. A 20% increase. They are building a monetary lifeboat. Indicator 2. Non-Western financial messaging. China's cross-border interbank payment system, CIPS, has seen transaction volume grow over 90% since 2021. It is a swift alternative in waiting. Indicator 3. U.S. Treasury held by foreign entities. 2015, $6.25 trillion. 2024, $7.6 trillion. Treasury Department. This seems like growth. But as a percentage of total publicly held debt, it has collapsed from 34% to 23%. The U.S. government is increasingly forced to fund itself domestically, the first sign of dwindling external demand. Indicator 4. Commodity invoicing. For the first time, in 2023, China conducted more cross-border commodity trade in yuan than in dollars. The petrodollar's foundation is cracking. Indicator 5. Reserve currency composition. The combined share of other currencies, non-USD, Euro, JPY, GBP, in global reserves has doubled since 2021. The diversification is into a basket, not to a single challenger, yet. Indicator 6. U.S. financial sanctions usage. 2,912 designations, 2023, over 10,000, Treasury OFAC list. The weapon is being used so frequently, it is losing its deterrence and motivating universal contingency planning. Indicator 7. De-dollarization rhetoric. From the IMF to former Fed officials, open discussion of a multipolar currency system is now mainstream. The elite narrative is preparing the public for the end of monopoly. Indicator 8. U.S. debt to GDP. 2000, 55%, 2024, 122%, Federal Reserve. The system's ability to sustain itself through cheap foreign borrowing is evaporating. The coming liquidity crunch will be funded by pure monetization. Indicator 9. Bond market vigilantes. The 10-year Treasury yield has broken above 4.5% despite Fed interventions. 2024. Foreign buyers are demanding a higher risk premium to hold the debt of a weaponizing state. Indicator 10. Strategic stockpiling. China and other nations are aggressively stockpiling critical minerals, copper, nickel, and semiconductors. This is preparation for a fragmented, less dollar-liquid world where trade is conducted in kind. The data forms an undeniable pattern. The flight is not silent to those listening. It is a deafening roar in the charts. Stage 2 is advanced, and history tells us what comes next. The new landscape, winners and losers. When the trap closes, it does not destroy everything equally. It redistributes global power and wealth with brutal, historical precision. Based on the precedents of Spain, Britain, and the USSR, we can map the coming geography of winners and losers. For the winners, the challenger and its bloc, the nation or bloc that offers a credible, neutral alternative financial infrastructure will attract the fleeing capital. This means deep, liquid bond markets, stable rule of law, and a commitment not to weaponize. Currently, no single currency fully qualifies, but the euro and a digital yuan/CBDC framework are the primary contenders. The winner will see a massive, artificial surge in demand for its currency and assets. Commodity sovereigns, nations with critical mineral reserves, energy, and food sovereignty become kingmakers. Saudi Arabia, Australia, Brazil, Canada, Russia. Their ability to demand payment in alternative currencies or gold grants them immense new leverage. They transition from price takers to system shapers. Hard asset guardians, entities holding physical gold, productive farmland, and key infrastructure outside the legacy system will see their strategic value revalued overnight. National gold reserves become the ultimate measure of creditworthiness, not treasury holdings. Financial hubs of neutrality, cities and jurisdictions that can position themselves as neutral clearinghouses between competing systems will prosper, as London did post-Sterling. Singapore, Dubai, and perhaps Shanghai could play this role. For the losers, the weaponizing state, the United States will face the loss of its exorbitant privilege. Funding its deficits will become dramatically more expensive, forcing either severe austerity, runaway monetization, or both. The dollar's internal purchasing power will plummet as global demand for it evaporates. The standard of living built on cheap imported goods and global seigniorage will collapse. Dollar-pegged economies, nations with currencies pegged to the dollar, Saudi Arabia, UAE, Hong Kong, will face impossible trilemmas: abandon the peg and cause internal chaos, or import devastating inflation and interest rates from a failing anchor currency. Legacy financial centers, New York and London, as the central nodes of the dollar system, will see their dominance challenged. Their business models are built on a dying paradigm. The American consumer and middle class, the greatest losers. The cost of imported goods will skyrocket. Interest rates on mortgages, car loans, and credit cards will remain structurally high. The wealth stored in dollar-denominated retirement accounts and bonds will evaporate in real terms. This is the historical precedent. The imperial core is always the last to feel the collapse, but the hardest hit when it arrives. Projected timeline, the compressed cycle. History's timeline is accelerating. Spain, 80 years. Britain, 40 years. USSR, 25 years. The digital, interconnected financial system will compress the USD's collapse cycle further. Based on the current velocity of Stage 2 indicators, here is the projected trajectory. 2025 to 2030, Stage 3, the challenger's gambit accelerates. This is the critical window. The digital yuan will be fully integrated into a BRICS Plus trading and settlement platform. The European Union will push for mandatory euro-denominated energy contracts, leveraging the green transition. A major commodity benchmark, oil, copper, lithium, will be publicly repriced in a non-dollar currency. The institutional architecture for a bipolar or multipolar system will be completed. The U.S. will respond with more aggressive financial sanctions, accelerating the very flight it seeks to prevent. 2030 to 2035, Stage 4, the Liquidity Crunch. The trigger will likely be a domestic U.S. debt crisis or a prolonged, costly military engagement. With the foreign bid for treasuries gutted, the U.S. government will be forced to fund itself explicitly through Federal Reserve monetization on an unprecedented scale. This will trigger a stagflationary crisis within the United States, high inflation combined with economic stagnation. The Fed will face an impossible choice: crush the economy with hyper-high rates to defend the dollar, or let it devalue to manage debt. It will choose the latter. A formal, large-scale devaluation of the dollar, a Plaza Accord 2.0, but unilateral and desperate, becomes likely. This is the point of visible, systemic crisis. 2035 to 2050, Stage 5, Terminal Abandonment and the New System. A formal or de facto global monetary reset will occur. It may not be a single day. It will be a cascading recognition. Key events will include a major U.S. ally, e.g., Saudi Arabia, formally dropping its dollar peg, a new IMF special drawing right, SDR, basket that drastically reduces the dollar's weight and includes the yuan, and the rise of a digital, tokenized system of central bank digital currencies, CBDCs, for cross-border trade, managed by a new or reformed institution. The U.S. dollar will remain a major regional currency for the Americas, but its global monopoly will be a memory. The pattern is clear. It is etched in the bankruptcy of Spain, the IMF bailout of Britain, and the barter economy of the collapsing USSR. Weaponization is suicide for a reserve currency. It trades infinite trust for finite power. And once the silent flight begins, it cannot be stopped, only managed. The data does not lie. The 14-point collapse in reserve share. The record gold purchases. The bilateral trade pacts. We are not at the beginning of Stage 2. We are in its middle passage. The question is no longer if the dollar's unipolar moment will end. That decision was made in March of 2022. The only remaining questions are how fast the cycle completes and who positions themselves in the sanctuary of the next system. The trap has been sprung. The clock is ticking, and you are living through the transition. Disclaimer: this video is for educational and informational purposes only. It presents historical analysis, opinions, and interpretations based on publicly available sources from institutions such as the IMF, World Gold Council, and U.S. Treasury Department. It is not financial advice, political advice, or a prediction of future events. All historical comparisons and references to modern countries, governments, or monetary policies are theoretical frameworks for analysis and should not be interpreted as claims, certainties, or endorsements. The future is not predetermined, and numerous variables could alter projected timelines. Viewers are strongly encouraged to research independently, consult with qualified professionals, and draw their own conclusions regarding personal financial and strategic decisions.